Consider the following simplified financial statements for the Stevenson Corporation, assuming no income taxes. Stevenson has predicted a sales increase of 15%, predicted that every item on the statement of financial position will increase by 15% as well. Create the pro forma statements and reconcile them. What is the plug variable here? So let's just assume that these numbers are 24, 24, 24, and we're going to do 25s beside them. So we're going to add 15% growth. So 32,000 times 1.15. Costs become 28,000. 60. This brings us to a new net income. That's also 15% higher, 87.40. Same for our assets. We assume that those are going up. So we have now of 29,095. Our debt will do the same. And our equity will do the same. For a total of 29,095. Okay, so what is the problem with that? Seems simple enough. But when we look at this critically and we go to reconcile it, if we had equity of 19,500, there's two ways to increase our equity. That is to invest more into the company or through net income. So here we have net income of 8740 plus 19,500. Well, that doesn't equal 22,425. So we need to add a plug variable to make that these statements make sense. Otherwise, any reader of these statements will be able to see immediately that there is a mistake. So we have our 2024 equity equals 22,425. Pardon me. 2024 equals 19,500. Our 25 is 22,425. Our net income is 8,740, which means that we should have a equity of 28,240. So this is what we would expect to see based on our net income. This is what we're going to say is there. So because we're saying this 22,425 is our equity, but this is what we would expect, we have a difference of 5,815. So that's the difference between these two. And all we have to do is plug it in as a cash dividend. So we have cash dividends of 58.15. So that would reduce our equity by the difference. So now, when you're looking at the pro formas, the equity makes sense. We can say that we paid out $5,800 to do that. In question 1B, we assume that half of net income in the form, that Stevenson pays out half of net income in the form of a cash dividend. Costs and assets vary with sales, but the debt and equity do not. Prepare the pro forma statements and determine the external financing needed. Okay, so if we know that net income is expected to be 2025, 8740. Leaves us with cash dividends. Cash dividends of 43,770. And that means that we're sending the difference to retained earnings. Also gets 4370. Okay. Also gets. So what I've got is retained earnings at 4370. And we have our equity that we're expecting to see. So we have 19,500. Which equals 23,870. We were expecting, so our pro forma said we would have $22,425. Prepare the pro forma statements and determine. Sorry, one moment. Right. Sorry, our pro forma debt and equity was going to equal 29,095. $29,095. And what happens is, with our debt, that is expected to be with our debt that is currently $5,800, we have a balance of $29,670. So we have a difference here of $575. So what we can do, because our retained earnings follow this set of rules, we actually have to reduce our financing by $575. So that would determine our external financing need is to actually pay down our financing by $575 to bring it to $51.25.